excited to introduce Mike Fickle. Mike has, we've known him for a long time. He's been a client for well more than 10 years. I think the official number is closer to like 12 years. He's a unique individual in that he spent, I think, close to a decade on Wall Street. Yeah, over a decade on Wall Street as a portfolio manager before starting his family, I guess, or growing his family and becoming a professional money manager. So super excited to have Mike. He's been a guest speaker, I think it was 2015 or 2016 at our New York conference, where we had a great time and got to dig into the underpinnings of algorithmic strategies and statistical modeling. But today he's going to be talking about sort of his cup and tea, which is portfolios, and I'm sure you're going to find it fascinating. Mike, welcome.
Thank you, Scott. Can you hear me and see me okay?
Yeah.
Okay. Well, appreciate it, guys. Thanks for the introduction. A little unique situation in that I'm on my way to my kids' wrestling meet today, so I wanted to get on and say a few things, and so it's a unique situation. And so if you hear the background, that maybe my kids, one of them not feeling well, my wife's driving. So, but anyways, thank you for having me on. Just want to give you a little bit of background. I don't get paid by Investment Quant at all, right? So I'm just on here, just kind of speaking about my experience. So no way are they compensating me. I actually, like you said, I'm an investor. My background, like I said, I was a hedge fund trader. I spent 15 years in the hedge fund industry. I was a full-time trader. I started following Scott, I think it was back in 2012, and it was Master of the Gap. And I would listen to him every day or get into a chat room, and I kept records of all the trading I did, and made a lot of money. And I knew what he was doing. I followed it. I traded it. I left Wall Street in 2016. I started my own investment advisory company. And when I did that, I realized I just didn't have enough time to spend on trading, and I needed to spend more time on running my business and starting my business. So Scott eventually turned his business into instead of they were talking about their trades they do, they were actually managing money, and then they got into leasing their strategy. So I went down that road just because if it was from a time consumption standpoint, it made a lot more sense to me. So that's how I got invested. I've been with them for a long time. That's my background with my background with them. I find them to be extremely humble, very trustworthy. I've spoken at their conference before. I've listened to them speak a lot of times. I've dug into their research, so I can say firsthand what they do. They're best in quality, and I wouldn't have my own money with them. I didn't think that. A couple things I want to talk about, and one of the things was diversification and why it's so important. And the reason why and we tell our clients all the time. So we manage money. A lot of it's in the stock market, stocks and bonds, traditional investments, right? One of the things that's unique about my investment advisory company is that we do a lot of alternative investments, and that's because I came from the alternative investment background. I understood the space. I've been in it. I've traded in it, and so because of that ability to understand the space, we invest a lot of money in there. With that comes a lot of due diligence, and I have to understand what those investments are. Not a lot of advisors will understand that, and so they just won't play there. But we think those alternative investments, which is how I would classify what Scott does as an alternative investment, is the best way to diversify against your traditional investments. So that's why, and he hit the nail on the head. We talked about, how do you diversify? What's important? It's how your investment moves relative to the other. And correlation is like the nerdy way to looking at it, the mathematical way. And it just basically says like when one investment's zigging, the other's zagging, right? They're not all working together in the same. They're going different directions sometimes. Sometimes they go together, but when your main investment, the stock market's down, for our clients, a lot of them are invested in the stock market. When that's down, we want something that's reliably up, right? And that's that negative correlation. So alternative investments is, I think, the best way to do that. And it's very hard to find good managers in that space. It's an unusual background. It's unique investments, and most people don't play in there or they don't understand it. So, but we think if you are able to understand it, it's one of the best ways to diversify against your traditional investments. And the big thing with being able to do this is if you put too much of your money into one investment, and we see it all the time, they put all their money in the stock market, right? Or they put all their money into some real estate deal, or they put all their money into anything, right? It's really hard to realize that long-term value because you get too emotionally attached. You have too much money invested in one thing. And when you do that, when something bad happens, and I always say it always happens. Something bad always happens along the way, right? And if you're over invested in something, you won't be able to stay in that investment, and you'll get shaken out of it. You'll panic. You'll get emotion, and then you'll get out of the investment. That usually happens at the worst time, and that's why it's so important to diversify, is because you don't get too emotionally attached. You're not too overly allocated to one thing, and then you'll be able to earn the long-term investment value that it gives. There's been lots of studies out there that show that most investors don't make the returns that the funds offer. Like, so if you look at mutual funds, and the mutual fund return 10% over the long run, the average investor rarely ever makes 10%. Why? Because they buy at the worst time, they sell at the worst time. They're too emotionally attached. They're over invested. There's a lot of different reasons why, but that's where it becomes like you have to understand how to diversify, and using alternative investments like what Scott does is we think one of the best ways to do it. So one of the things we talk about is what we look for in these sort of non-correlated investments. First and foremost, quality and safety. That's the most important thing. We want to make sure that they're best in class, they're good at what they do, and they're safe investments, right? They understand downside and how to risk manage. Those are really important. When it comes to alternative investments, this is a hard category because it's so unique. One of the most important things we look at is how invested are the owners, right? That's usually the first question we ask when we're looking at alternative investments is, are the owners invested? And not only mean just like, do they have a couple, $1,000 into it, 100,000, like how much of your own net worth are you invested in this company, right? The more they're invested, right, the more strongly we feel that it could be a good investment, right? Because they're all in on it essentially. So I know Scott and his team are very heavily invested, and that was one thing that we definitely look at. So once you kind of get past that, I think there's three main things that we look at in terms of like doing due diligence on alternative investment. Number one is, are the strategies dynamic? And Scott talked a lot about that, because especially in this environment where it's short-term trading, things change quickly and they evolve over time. To change your models as the markets change, and that's a big thing. I was used to listen to Scott back in 2012, and so I've seen him evolve over the last 12 years, and they have evolved a lot. And I think that's probably one of the most important things. The second most important thing is prudent risk management. And a lot of times you get into alternative investments, and if they're leverage strategies like these are, you have to be really, really cognizant of risk management. And if you don't have really sound principles when it comes to risk management, I would never invest, but I know they do. They talk a lot about their downside, how much they risk on each trade, what they do in drawdowns. And I know they are really prudent when it comes to risk management. And then the third thing is a track record. We look at a track record. We look at, in sample, out of sample, if they're showing us stuff like that. We're looking at how well done live trading. If something's unusually good, I always probably think I wouldn't invest in it. We looked at a strategy once that showed like over a 2-sharp ratio, and the returns just didn't look right. It looked too good to be true, and we just never did it. Just never went past that point. So they have to have a good track record, and it has to be a stable track record. We expect drawdowns. We want to analyze those drawdowns, and everything they do sort of checks the. And that's about it, man. I think besides that, the only thing I'd say is we talked about, or the highlight point there about setting the proper expectations. I think the most important thing you do in this is you focus on that max drawdown. You analyze what that max drawdown was, and you say, can I handle that, right? And you got to expect that that's going to happen right out of the gate. And we usually even say, even gross it up, probably about 50%. So you take the max drawdown, you say, if it was a bigger than the maximum drawdown ever, maybe 25, 50% more right out of the gate, would I be able to live with that? And if you can, then you properly sized it. And that's probably one of the most important things. In terms of how to size it, I mean, it can really vary. Our clients can be anywhere from 10% allocated to alternatives to over 50% allocated, right? And it's just a level of how comfortable you are with something and how confident you are. So when you start off small, get comfortable with what they're doing, build confidence, and those allocations can really vary. I wouldn't, anything less than 10%, you're not that probably interested in it. And if you get up to the 50%, you got to be really, really confident and have a long kind of personal track record with them as well. So those can really vary, but that just kind of depends on your comfort level. So that's kind of about it. I'll stick around for a while if anyone has questions in terms of how we look at things from a due diligence perspective, from how we allocate any of that kind of stuff. So I'll be here to answer questions.